Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Pierre, Senior Manager and Mentor. How you doing, Pierre?
All right, Mark. How are you doing? Thanks for having me on.
Oh, you're welcome. You know, I figured I should have you on here because you provide value as an accountant, right?
Yes, thank you.
And you have all this. Well, actually, let's start.
What
Pierre,
an on-point topic,
right? Pierre, since you are a senior manager and mentor, how long, first off, have you been doing this?
This is my Larry Bird year. 33 years.
33 years.
Public accounting.
Is this like consecutive? Did you take a break?
Nope. Straight through.
Straight through?
Relentless. 33 years. Yeah.
Okay. So you've probably seen the landscape of accounting change probably considerably, right? Because for those who have ever been to his office or have been blessed to ever go into his office, he's got like this old like crank.
That is a paymaster. That is my grandfather's. And I believe it's from 1920. He had a hospital and he used to write checks with that. So it's a paymaster check writer, but it looks like a calculator.
See, I'm learning something already.
That is pretty cool.
But so here's my big thing. 33 years of experience, you've learned quite a bit. And people say, well, what's the big deal? What value does an accountant have? Right? So let's actually do a little time travel. What value did an accountant bring back in the day, 33 years ago, as opposed to what value is an accountant bringing today?
So great question, because it's basically the same thing. It's taking what...
Very few jobs don't change at all over 33 years.
It doesn't change, but what we're bringing, it's just different manners in which we're bringing it.
Okay.
So we're changing. We're trying to take your pile of activity that you view as repair shop, machine shop, restaurant, whatever, and we're trying to relate that to you to tell you how you're doing, and then to do some other stuff, planning, tax work, and budgeting for the future and stuff like that. So it's the same job. It's just different. We now have computers. I remember rolling out the 11-column paper that we would tape together, and year after year we would roll that out, and you had to put that tractor bought in 1937, and here we are in 1980, and you're still tracking that thing or something like. But it's fully depreciated this time. We used to roll that out. Now it's all on the computer, but it's still the same thing. We're trying to take your pile of financial information and make it usable.
Okay. So obviously the tools are very different over the course of the 33 years. And that has, of course, helped speed things up. It makes things a lot cleaner, more transparency, more communication with clients, all that jazz. What would you say the biggest change to you is, and probably the most valuable change?
It is definitely the technology. Doing that depreciation schedule with, 3,000 assets on your books. A lot of our clients don't have that many, but we have hundreds of assets on the books, and be able to track that by hand was very difficult. You make one mistake and the whole thing is off. Computer, you make a mistake, you can usually find it and just rerun it in what used to take hours would take 10 seconds.
Well, actually, I actually want to shift the thought about this for a second. We've gotten more advanced, right? Sure. You can find stuff. There can be errors because it's far more, I guess I'd say complex than it used to be. There's more laws.
Yeah. Yes.
So because you can find it easier, I mean, the IRS can find it easier too, right?
Yes.
They've gotten a lot more tech savvy.
They are very far behind in their technology, but they're getting better. It was only a number of years ago, they couldn't match a K-1, which is the information that comes off of your S corporation and goes to your personal. They could not match it from your personal to the original K-1.
They had to get physical hands on it to make that happen.
Yeah, so they couldn't see that. Like your W-2 that you get from your employer sends it in, the IRS puts it into their file, puts it into your account, and then when you file your tax return, they match that instantly. And they've been doing that for a long time. So if those don't match, you're going to get some kind of notice from the IRS. But it was only recently that they were able to match S Corp information. So they are constantly getting better. And you get 1099s from all kinds of things. You get 1098s for your real estate tax. You get your mortgage interest. You get all kinds of stuff. And more of that is going to the IRS. And so that is another thing that leads to, Pierre, you're going to be out of a job because all taxes are going to be done automatically. And I say that would be fantastic because taxes are not just what we do here. We take what your business is and we make it into a usable form for you. That's why it's the same thing every time. And we get the same questions 30 years ago versus today. A lot less television shows, but now, hey, how much money did I make? Where did it all go? And, how much do I owe in taxes? You always do get that question too.
I'm about to say that.
But those
over
are the
33 years, same question.
For 33 years. Where is my money?
And why don't we actually address those right now? What are the answers to those 3 questions?
So they're all kind of all over the place. How much am I making money? If you have good records and books, you can say, here's what you spent money on. This is what the money that came in. This is how much you have left over. Pretty straightforward. But a lot of times people don't understand what that means because they say, I just had this last week. I had a guy come in. Hey, these are the deposits into my bank account. This is the payments out of my bank account. That's only this much money. You're saying it's this much money. You're wrong, Pierre. And he's like, okay, well, thank you for that. We do. This is my favorite part. We do more than 1,000 tax returns. This guy actually does 3. So, okay, he's getting closer. But we have a process that takes the information and puts it through our system and follows the accounting rule. So one of the biggest differences here is some of those payments that went out are not expenses. Take a car that you buy. If you buy a car, you have a loan for 5 years. Car's $100,000. It's a middle of the road car. No, you're buying a truck. You're paying that off every month. You're writing a check to the auto finance place for, $1,400 a month. So on his worksheet, he was making that payment, $1,400. But we put that car on as an asset, and then we depreciate it over the useful life. But hold on. We needed the deduction in year 1. So we took all the depreciation in year 1 for that car, the $100,000 car. Now, all we get going forward is just the interest that he's paying. So that $1,400 that he thinks is an expense, we've already pre-expensed that in year 1. Now we're in year 2. He says, I made 12 payments of $1,400. How come I don't see that? Well, we took it in year 1. And if you don't have a good set of books and records and have an accountant or somebody who understands what that means, you're saying I should have 14 times 12 deduction, and you're only giving me maybe half of that because that's all the interest is worth. You're wrong, is what you get. And you're like, okay, we're not wrong. But what you did write all these checks. We do the bank rec to make sure, because cash is king. We do all those checks to make sure that works. But not all of it is a deductible expense because we've already taken some of it. And a good accounting system remembers that we took $100,000 in year 1. Now we only get the interest going forward. It's a classic example.
And that makes perfect sense. And I actually want to go back to what you were saying before. The taxes thing won't go away ever. No. And we know that because we've had this discussion on a previous episode. Who knows how much money you make? The IRS.
Yes.
So you doing all this for the IRS is really, I don't want to say redundant, but in many ways, if you guys could go away, it's already been done. They know the amount that's been made. Your role is to fill in the gaps.
Yeah. Because really, they know most of it. Again, they're still not perfect, but they will do the same thing like my client did. He took the totals and said, okay, that's how much money went in your bank account. Oh, well, you know what? Some of that was a loan that somebody paid you back. Again, the accountant has to take that and say, okay, that's not income this year. That is you did a nice job and you gave one of your other people a loan to help them, I don't know, buy their house or something, and they paid that back to you or start their own business and they paid that back to you. That's not income. But if you don't have good books and records, very hard for you to remember that $40,000 was a loan payback or to tell the IRS that.
So let's really get into what you do now. I feel like this is what's that movie? Office Space? What is it you actually do?
Well, I come in at 8:30. I probably do about 15 minutes of work pushing one button to do a tax return. That's what I do.
Okay. No. But does, what is it you do that actually really helps people? Like when you say, I do this activity, this is what provides the most value to a client. What would you say that is?
So we have a team here that takes that data and puts it in the right bucket. It says, this is a loan payment. but some of it is just paying off the loan that we parked on the balance sheet. Okay. Some of it's going to interest. So we're turning your transactions into what they are on the books. And it's not just for taxes. It'd be to make your financial statements look good so you can get your next loan, so you can buy a building, because the banker can look at that information and say, okay, this guy knows what he's doing. Mm-hmm. Let's give him some more money so we can buy another building.
I mean, as we've said on other podcasts, it saves a lot of effort as opposed to when you're handing it to them on a napkin, right?
Yes.
Right. So let's kind of, I want to actually sum all of this up. So an accountant, they're first off there for the client. Hey, I need to understand what's going on. You can translate this from gobbledygook into something that makes sense. You, in many ways, act as a liaison to the IRS. Hey, I've cleaned this up for you guys, even though you already know about it.
Yep.
Here's the work. And then when they, and by they, the client, go to the bank or anyone else who's going to potentially give them money or help them out in a way, or what are some other examples besides the bank that they may be visiting?
So for themselves, there was a classic case of, I'm going to use Clay Hamlin, and you guys might know him from this podcast, many years ago, and he's an accountant. We all do this, plumber's leaky house. He admitted this, if we were thinking about buying a new bubbler in the break room.
Okay, for those who aren't in this area, bubblers are water fountain.
Water cooler, whatever. One of those water coolers.
And bubbler sounds better, but
you get a water cooler.
Yep.
Somebody came and asked him, hey, the water cooler's broken. Can we get it? He said, I would look up in the air and I would say, is my day going well? Is my day going bad? Yeah, let's get the water cooler, right? And that was his methodology for doing it. Planning and buying a building is a little more, but it speaks to the point. He didn't know if he could afford a water cooler or not. He easily could afford the water cooler, but the point was he didn't have a full budget and a full set of books for his business at the time. This was many years ago. And
yeah, this was not last week.
This is not last week. This is a number of years ago. And he said, when you put a budget together and you know what your situation is, you think, oh yeah, we have $10,000 set aside to do repair and maintenance this year. And we haven't done any yet. Let's get the water bubbler or whatever you want to call it. And that's what makes it different. So not just the bank, not just the taxes. It's, can we hire a new manager next week? Do we need more staff? Do we have too much staff? Is that why I'm not making enough money? It's all taking that financial information and helping the business owner make a decision with it. And like you said, not on a napkin and not that morning. Mm-hmm. It's taking all your stuff during the year, because people make mistakes. They put things in backwards, or they forget to say that was a loan payback. And so to have that information during the year and to talk about it makes you much more prepared to hire the new person, to see if we can buy a new building, to open up a new market, to prepare for your taxes, and to maybe get a new building. All those things are important.
And the forecasting thing is really big, because yes, you have your business, you're doing business, you know that you have some money, right? But if you need to repair something, whether it's a bubbler or a lift or whatever, right? Being able to say, can I afford this? As opposed to, I can afford this.
Yeah.
Right.
Or always thinking, we're trying to save money. We're trying to cut costs, but gosh, your employees are going to be dehydrated and not do a good job. Maybe you should get that.
There is something
there's always
to that
more to it.
And to go back to, what about hiring a new employee? When Pierre can talk to me and say, hey, this is how much you're spending. This is how much you have available. And you can say, this employee, if you hire someone, you pay them, insert whatever, how much money, will that free you up to do more than what you're paying them? The business owner frees them up to do more.
Yeah.
Like, can you earn that much more for the business? Can you bring in that much more business? Can you save them whatever in that amount of time?
Can you concentrate on another part of the business?
We've done that a lot too, especially with the auto repair. Get them out of the shop.
Yeah. Not everybody wants to turn wrenches forever. Mm-hmm. They'll work on the one at home.
Yep.
They'll put the pipes on their motorcycle at home at night. But the other piece of that is to know how much a new employee costs. Mm-hmm. Can I buy a new employee? Well, how much do they cost for a new employee?
You
have 6 employees. They all cost you this much. You have health insurance. You have to buy them a computer or tools or whatever else you needed. A new employee costs you not the $50,000 salary, but $80,000 with benefits, pension plan, and a new space or new bay, a new lift, whatever. It gives you a real idea of what that actually costs to buy that person. And then, okay, how many new clients, cars a week, repairs each day do I need to make that work?
So essentially what I'm hearing, Pierre, is you're not worried about having to go visit the unemployment line?
No, sadly, no.
Anything else you want to tell me about basically your job?
My job. Well, I tell this to people all the time. Accounting is the simplest thing on the planet. And people are afraid of it, but accounting is debits and credits. That's all it is. Mm-hmm. The problem is the computer, the people, and the IRS. You get past those three, and it's a great job. But you always get an answer. It's not like being a doctor, and you have to figure out what that cough means. It could mean 1,000 different things. If I have a debit, I need to have a credit. That's the rule. Simple as that.
Well, one more thing that I want to ask as we wrap up. What do the next 33 years of accounting look like for you?
I surprisingly get that asked a lot. When are you going to retire? I don't think I'll ever retire. Accounting is so easy. It's so easy. You don't have to dig. You barely have to think. You just have to debits equal credits. But let's see how I do with the technology.
Well, that's actually where I want to go with this question. Not that I will be very sad when and if you decide to retire.
33
what
years.
What should I expect to see from accountants in the next 33 years? Again, you've seen how it's changed so far. What do you think it's going to be like real quick?
I think you'll be able to more quickly get that information to you. POS systems feed everything. Bank accounts feed everything. We'll have less input and less input errors. There'll still be mistakes made, but you're going to get information faster. So you have to be prepared to analyze that information. A lot of times accountants were always trying to catch up because taxes are the year before. We're always trying to catch it up. There are firms that don't do taxes and just do planning, but maybe you'll be able to see people do more of each. I think we just had our stat today. We were at 75 completion by March 15th. That's pretty good corporate completion rate by the deadline. I mean, and only 25% of our clients were extended.
Love that. Thank you, Pierre.
You're welcome. Thanks for having me.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.